Hey guys, welcome. Pumped today. We're going to talk about storage units as an asset class. I have with me Senior VP over at Avenue Living, Gabe Millard. Gabe, great to have you here today.
Thanks for having me.
Winnipeg. Portage and Maine, baby.
Beautiful Winnipeg. I love coming out here.
I like you guys because you guys are focused on the prairies. Like most of your assets across all of your different funds, you guys have a farmland fund. It's focused in the prairies. You guys have a real estate fund. It's focused in the prairies. And so you do get the lifestyle that we live out here. It's a little different than Toronto, Vancouver. Today, I want to talk about storage units as an asset class. First off, maybe talk to me about the asset class as a whole, and then why you guys decided to get into this.
Yeah, absolutely. So storage is a really interesting asset class that's got a lot of history within Avenue Living as an organization. So Anthony Giuffre, founder, CEO of Avenue Living, his father actually was the kind of founder or grandfather of self-storage in Western Canada. In the 70s, he was down in Vegas and he was at a trade show and he saw the self-storage model. In the US, they're about a generation ahead of us in terms of storage. And he brought that model up into Calgary and did some merchant development. He is now about 95 years old, looking for an exit opportunity and looking to retire. And
slow things down a little bit?
Yeah, he was still coming into the office on a daily basis, but he went to Anthony asking him, can you buy my building? I can't run this anymore. We didn't have a fund for this, so Anthony tasked us and the team in order to start looking at the industry and see what we could find.
This is 5 years ago?
This was in 2019.
Okay.
And so what we found was that there was a lot of really unique aspects about the storage industry. One, it was a very fragmented market. There was a few big players at the top that had consolidated all of the A-class facilities in downtown locations across Canada, but they had left everything else.
Tons of mom and pop shops.
Exactly, the domain of mom and pop, you could say. 83% plus in mom and pop facilities. And the other side of it too is that those mom and pop facilities, they hadn't done really any institutional management or upgrades to it since they've been running it. They've been running it as a nice family cash flowing business, right, but they haven't kept up with the new trends of today's market. So we were able to go out and quickly capture a large amount of assets and really drive that into a fund and notice really strong opportunity there.
Okay, so the asset class as a whole for me, I reached out to you guys, I don't know how many years ago it was, that I was interested in this asset class because I went and took a storage unit. And I was like, this is upsetting for me as a Canadian father and homeowner to have more storage. And I was so frustrated with the whole concept. I went down, I bought a storage unit, I paid for it, I was so annoyed. I put my lawn chairs and my golf clubs and whatever I put in there, and I was upset. And I said, I should buy one of these things. And I said, I'm not going to buy one of these things, but I should because there's money to be made here. Because if I'm buying a storage unit, other Canadians are buying storage units. And I talked to my buddies and I talked to my friends. They all said, yeah, dude, I have a storage unit. Everyone has a storage unit. It's how it is. It's life. And I was like, huh. So then I was like, hey, who does this asset class? And then you guys, I think, as far as I know, are the only ones in Canada that are doing it. So that was my attraction to the asset class. Now, so if you think of real estate, okay, we buy a piece of property, someone uses it, and we charge them rent for it, right? So like a storage unit could be considered like a really small apartment, right? Less services, but really it's a 20 by 10 apartment in the middle of usually suburban areas. But it's a little more than that, right? Because you guys actually apply technology and automation and all sorts of stuff to increase revenue and bring costs down.
Absolutely. So the interesting thing about storage is it is a real estate play. You are buying a building, you own the real estate underneath it. But it's also a much more of an operating business than other forms of real estate tend to be. Your lease terms are month to month typically. So customers can come and go on a very frequent basis, which is a double-edged sword. If you're a better operator than everyone else, you can increase rents right alongside that and remain full. If you're not operating up to today's standards, they've got other options they can go to. And so what we do is we try and take what the institutions have done over the last 10 years and apply that to these lower density mom and pop style assets. So if you go to your downtown new self-storage facility, they're going to have climate control and some nice amenities, but the other things they're going to do is they're going to have a website that's probably SEO enabled, they're going to have 24/7 access, and they're going to do something behind the scenes that not a lot of people see, which is dynamic pricing. If you think the airline model, where as people are clicking on 10 by 10s or 3 by 10s and you start to have lower supply, that price is going to ratchet up on a daily basis.
Right.
That's what we can take, and we take a light version of that and apply that to lower density assets and really bring in our own unique management style to that.
Do you guys own that software? It's just software that you buy or you rent or whatever.
Yeah, it's software that you can
It's
rent.
like storage software that's existed in the US for a while.
That's exactly the case. The difference being is that it's not an affordable thing to do if you own 1, 2, 3,
Right.
5
Economies of
facilities.
scale.
If you own 300 facilities, all of a sudden that drives the return.
Okay, talk to me about the size, how many square feet, how many facilities?
So we are currently at 6.7 million square feet.
Wow.
That is an estimated for us to be within the top 25 operators within North America. And we're currently on an acquisition growth spurt, so we should be crossing over 7 million square feet here soon.
Okay, what kind of returns does someone expect to get, and what kind of returns are you guys targeting?
Yeah, so we target as a fund level a 12 to 15% targeted IRR over a 10-year period. That is net of all fees. On an asset-specific level, we typically target into that high teens return. Really what we're looking at is buying in a 6 to 8% cap range. So it's a very high percent cap rate. And then we've got a viewpoint of manufacturing about 150 to 200 basis points of yield through our operations.
Okay, so you're buying at 6 to 8, you're paying less than that on your debt, you're getting that spread levered, and then you're adding revenue, NOI, to the bottom line by either reducing costs or increasing return with this dynamic pricing model.
That's exactly.
So you buy this thing that was potentially underperforming on a relative basis, relative to this mom and pop shop that was run by my parents or whoever, and you increase revenue, decrease expenses, and based on the cap rate, you're able to generate 12 to 15.
Exactly, and that 12 to 15% is inclusive of a monthly distribution. We pay a fixed targeted distribution per unit, and anything over and above that would be capital appreciation.
How much does someone get as a return if they invest in the unit? What's the yield?
Yeah, currently yield is around 5.5%.
5.5% yield, so that's a distribution. Is that return of capital?
That is 100% return of capital to date.
Okay, meaning you don't have to worry about getting a T3 or T5. You don't pay tax on that in the year you receive it. It's effectively a deferred capital gain, so you could pay tax down the line. You can control when you want to pay your taxes, but you pay nothing today, which is unbelievable.
Essentially, the way that we run our business is we go out and we acquire a large basket of goods. Typically, it takes about 18 to 24 months to really stabilize and generate that return. So we buy a large basket of goods, that's going to drive the return for the next year, and we just stack on top of each other on an annual basis.
Now, when you buy it, you're still generating returns from that asset, just not the 12 to 15%. It does take time to...
Exactly. Immediately cash flowing, just not that excess value appreciation on top.
Okay, so I took a storage unit. My neighbors, my buddies are taking storage. What's happening to the storage industry as a whole? I'm not crazy here. This is a growing industry.
This is a growing industry. I think you can take a look down at our friends in the US to see what's going to happen. I get asked a lot from people in Canada, isn't this a consumer or like a luxury good that somebody will just get rid of their storage locker? Nobody asks me that in the US because they're a generation ahead of us. So kids have grown up with their parents having a storage locker their entire lives, and that's just what you do. So it's something that's been growing.
Depressing. It's depressing. It sucks.
It's a fair point. Basically, a bet against storage in today's life is a bet against the consumerism of North America.
No, we need more junk in our lives. It's unfortunate. We always need more junk. And if you have a place to put junk, you know what you do? You go and buy more junk.
Well, now you got some empty space.
Yeah, you got to fill it with junk.
So what's happened, though, is I do want to mention this, and you see a lot of news reports coming out about overbuilt of storage. And what's interesting on that is because in the last 5 years with a zero interest rate policy we've been, a lot of firms got into the development space. And they got into it because it was a quick, easy flip. You could go and you could put up a storage locker very easily, and you could sell it out to one of the big guys. That was all done in the primary markets, and really in the US, but also in Canada a little bit, but in the primary downtown cores. But again, when you go back and you go anywhere outside of the primary locations, going back to your point of us being in the prairies and other locations throughout the middle of the US, the underbuilt of storage is there because the institutions didn't come into it.
Yeah, they don't want to touch like Moose Jaw or Lethbridge.
They're not coming there.
Yeah.
They don't even know where that place is.
Yeah, it's not even on the map.
Yeah.
Neither is Winnipeg, probably. Okay, so incredibly stable revenue, return of capital, a great diversifier. It's an asset class I believe in. It's an asset class you own. It's an asset class that my clients own, and my clients have been very thankful to own. It's really low volatility because the NAV doesn't change on a regular basis. The NAV, so the share value that you see on your statements, remains the same for the entire month or quarter, or typically they're reassessed every, half year or something like that?
Yeah, so we do a monthly valuation on our assets. Typically, we'll do a deeper dive on a quarterly period, on a half-year period, and on an annual basis. So we will value on a monthly basis, but real estate doesn't change that often on a monthly basis. So typically you'll see a revaluation every quarter to half year. And then on an annual basis, we do a big deep dive that's alongside EY that underwrites every one of our assets. We get about a third of them appraised on an annual basis as well, just to make sure everybody's valuations.
Yeah, so how do I know that my client's value that shows $11.68 on the statement is actually $11.68 of value?
Yeah.
Like Ernst & Young is there, they're auditing.
Yeah.
But how do I know that those assets are actually there?
Yeah, that's a great point. And that's the beautiful thing about hard assets. One, you can go onto our website and go on and rent a storage locker from here anywhere across North America.
That's a good point.
And two, we do it monthly. We also have a third-party investment fund manager in Vigo Capital who reviews our NAV on a monthly basis, as well as then you've got your third-party appraisals that are done alongside Ernst & Young to make sure that everybody is on side and everybody is along in the same aspect and has the same valuation.
Okay. So those of you that follow my channel know that I'm a big believer in alternative asset classes. I like owning stocks. I think stocks make a ton of sense. But I believe that most people should own somewhere around 20 to 40% of their liquid net worth in alternative asset classes. I believe that real estate, usually for most people, forms a big part of that. It doesn't have to be traditional real estate. It doesn't have to be apartments for everyone. It can be other types of real estate. It could be farmland. It could be music royalties. It could be infrastructure. But it could also be storage properties, which have a little bit of kick to it in that you're able to increase the NOI on an operating style. As long as you can continue to do that, you should be able to continue to generate these returns. So very interesting asset class. Gabe, thanks for joining me. Anything else you want to add here?
Nothing else I want to add other than I want to thank you for spending the time, and thank you for your listeners for your support and appreciation.
All right. Tell us your comments below. Do you believe in the asset class? Does it make sense? Do you own any? Is this something you wanted to buy? And don't forget to like and subscribe, guys. Thank you. We'll see you guys in the next video.